listened to the Macy's conference call this morning, you think we're definitely headed into a recession. Yeah, it was that grim.
The house of pain.
The culprit? Well, Macy's had too much inventory, the wrong inventory. They also saw a lack of foreign buyers. Makes sense. With the strong dollar, it's very expensive for foreign tourists to come to the United States. That big Herald Square store, they used to come there, right? That's what tourists come to see. And they're definitely not going to come here on a shopping trip right now, not with that dollar going higher. The Blue Mercury beauty and wellness business is excellent. Digital business, very strong. But it wasn't enough to save Macy's from a severe disappointment. With the company earning 28 cents a share, Wall Street was looking for 45 cents. Wowza. That's so bad, I almost thought it was a misprint. To make matters worse, Macy's is also right in the crosshairs of these latest tariffs on Chinese merchandise. Again, if you were on the call, management's concerned about what higher tariffs might mean for the consumer. I think it's a legitimate worry at this point. For everyone who's been fixated on the bond market, assuming that an inverted yield curve means we're headed for a nasty slowdown, Macy's is concrete evidence that at least one part of the economy is in pretty rough shape. Just look at the stock right now. It's sporting a nearly 9% yield because investors, well, they don't believe that the company can afford to keep that dividend at these levels, even though the company's balance sheet is the best that it's been in years, and management didn't even shade down their forecast by very much. The truth is, older investors are thinking back to 1992 when a debt-laden, over-acquisitive Macy's filed for bankruptcy. Personally, I think that's highly unlikely, but we all know that retail is a tough business, and there are lots of companies that can't make it. We do know that Macy's has structural problems, just like every other mall-based department store chain, especially the ones that miss the mark in terms of fashion or that rely on spending from tourists. So I can't blame anyone for looking at this quarter and concluding the bond market is correctly forecasting the end of the expansion, followed by the beginning of a recession, especially if the now delayed tariffs get slapped on all those Chinese exports come December. But at the risk of sounding a little Pollyannish, I don't think Macy's is all that representative of retail in general. When you're trying to judge a whole industry, you should never take your cue from a troubled company. And right now, all the department stores are indeed troubled. That's why I'm betting the consumer might be okay. People aren't shopping less. They're simply shopping at different places. As big as Macy's may be, it's puny compared to WATCH, my acronym for Walmart, Amazon, Target, Costco, and Home Depot, all of which I think are doing pretty well, certainly better than Macy's. These five companies have the scale to strong-arm their suppliers into absorbing the cost of the tariffs, or they could slightly raise prices to pass them on to the consumer. Given that the prices are already so low, I don't even know whether people would notice. If the consumer's really hurting, she's going to shop at a revamped Dollar Tree or ubiquitous Dollar General. These are trade-down plays that tend to benefit from a slowing economy. Rather than buying clothes directly from Macy's, the consumer waits for them to offload their excess inventory to TJX or Burlington stores at a huge discount and then picks up the same stuff for a fraction of the price. So, yeah, the Macy's conference call was brutal. But I think that's less about the state of the consumer and more about the state of the mall-based department store. In this day and age, you have to have a major online presence, or you need to offer incredible bargains like the dollar stores or the off-price chains. Everyone else, let's just say their stocks are very hard to own. Let's go to Nick in Arizona, please. Nick.
Hey, Jim. Thanks for taking my call.
You're quite welcome.
Yeah, so with the retail sector being beaten down as much as it has been, I was wondering what your opinion for Nordstrom is as a value stock and also a dividend stock.
You know what? They're not working. The value stock and dividend stocks are simply not working. For instance, my Travel Trust owns a position in Kohl's. We sold some the other day. We were tempted to buy it back today. We said, no. Kohl's, Nordstrom, and Macy's are all regarded as one big bad stock, even though they have good managers, and I am not going to put you in that house of pain. It's just too hard. How about Tim in Florida? Tim.
Hi, Jim. How are you?
I'm good. How are you?
Hey, I'm good. Thanks. I bought Stitch Fix mid-July at about $29.60. Now a month later, it's lost about a third of its price.
Right.
It appeared to be on the upswing. The financials, while not great, seemed to be okay at the time. It's an interesting business model. Now it's at 21. What are your thoughts?
Well, I think that this is like a lot of like Real, like Revolve. I mean, what happens is this whole cohort is getting hurt. And the reason why it's getting hurt is people feel that all these IPOs were too hot and they've come back down. I think Stitch Fix is a very good company. Is it a $2 billion market cap company that should stay there? I think that has to grow into that market cap. When I met management, I think they're very, very smart. I want you to hold on and maybe buy some a little bit lower. This is a brutal market right now, and I don't want you to panic. All right, retail's become very hard. Not everyone can make it. Macy's tells a brutal story. In this age, you have to be online or off price. Macy's is caught in between. Much more mad money ahead. The story Macy's is telling might not be a good one, but I'm pointing to retail players that could be worth considering following their massive declines. Plus, my sell-off strategy session. I'm opening up the phone lines to hear from you, Cramerica. Let me help you navigate the market's unknowns. And Tilray's drop today doesn't necessarily instill confidence in the cannabis space, does it? But one company in the group has been quietly beating expectations and rallying off its lows, and it's not the big dog. I'll reveal the name when I sit down with the CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.